Banks, inflation, and fiat currencies. These are very prominent topics, and today I'm going to talk about them and maybe give you some new insights about what is really going on there. So let's get started. Among the many topics that can be filtered out in macroeconomics, economies, and economic conduct, money, etc. Banks, central banks, currencies, and also macroeconomic metrics like inflation are the most interesting, especially in the last year or in the last couple of years. Actually, the topic of inflation has become very prominent because it has hit many countries, some more, some less. For example, China is one of the countries that was not that hit by inflation, actually is still growing, but this has also other reasons. But generally, most countries experienced high inflation rates that they weren't used to in the period a couple of years before the corona pandemic. So the narrative is very interesting here because many people that talk about inflation that have some kind of a semi connection to the financial markets are always bringing up this topic of central banks printing money, and we have the rising inflation because of that. But it's not only the semi-structured argument, but also, the layman is entering into the discussion and saying, well, the central banks, because they are printing so much money, this is why we have inflation, and this is why we are in such a bad situation right now. Now, this is an extremely simplistic account, and even more simplistic is the assumption that because that is the case, we need to get rid of fiat currencies and money altogether in the form of like physical banking notes and so on and so forth. Very naive thinking, in my opinion, and completely false. For good reasons that I'm going to explain today in this episode. And recently, we have seen that many US banks actually filed for bankruptcy, also kind of accompanied by the, I wouldn't say failure, because it's very kind of self-constructed destruction of the Credit Suisse in Switzerland. So people also think about or kind of talk about banking crisis. Banking crisis, obviously, when we hear that, we think back to 2008, where the global financial crisis started in the banking sector, and obviously the associations are not very good. So there are many topics kind of interrelated, but there is, and I can, I feel some sort of a fearful atmosphere in and around the financial markets. Me as a manager of or in a financial analytics firm in Germany, I have kind of the insights into what people and clients and market participants think more or less, and there it is a very prominent theme that this fearful thinking of do we have a banking crisis? Are we going to enter a recession? How hard is this recession going to hit us? How long it is going to last? And so on and so forth. And obviously the most simplistic account, central banks are printing money, they are bad, we need to get rid of fiat currencies. So where do we start here? It is very complex, and I do not think that I'm going to be able to sufficiently explain the whole chain of logic here, because it is very complex and there are many factors that play into it. So this is why I'm probably also going to make a more detailed episode on this topic at some other point. But in this episode, I want to start by actually playing the reverse card I wish I had one here to kind of show you the reverse card in this case, because if you are simple enough to think that central banks printing money means inflation in a direct connection to one another, yes, then I can also argue that as a central banker you would know that, most probably. As technocratic institutions, central banks hire very developed and well-educated people from the finance sector and economic or other economic institutions. So we would expect that people would know if printing unlimited money is increasing inflation or not. And I mean, it is a very simplistic account. So there are other things that central banks do. They buy back, for example, certain sums of money overnight or long term, for example. And this is how money can be pulled out of the system while also providing good credit conditions to short-term financial institutions or those lenders that want to park their money in short term. So this generates kind of growing incentives for businesses and banks and other money or financial institutions. So this is a very important aspect. But on the other side, it is also important to see that central banks are extended agencies of the government. So we have different macroeconomic policies that are not only informed by financial goals. So governments actually need to fulfill a wide range of political and societal goals where economic policy plays a role. It can be that you want to influence demographics, education, foreign policy, and so on and so forth. No matter what you are doing and which route you are going to take and aim for, economics plays an important role. You can do this fiscally by, for example, raising taxes, reallocating money, and using certain incentives, tightening or loosening working conditions, and so on and so forth. You have so many fiscal measures that you can actually use to influence your political and societal goals, but you also have the monetary policy that central banks are more or less independently trying to accompany. And therefore, those institutions, they have the only mandate, regardless of what political party or what kind of regime is in power. As semi-independent institutions, central banks need to fulfill or kind of help and support the political route that macroeconomic policy is taking under that regime. So having this account or this simplistic view of just printing money for the sake of pushing financial markets to the edge is not quite true. Because if you have monetary expansion, the question is also, where does this money go? Printing money or monetary expansion is, in the simplistic view, not thought through in the sense that we look at where the money is going. Usually people just assume they're printing money, we have more money, and it becomes worthless over time. But that is not really the case, because printing money actually functions via the interest rate and other forms of giving credit to financial institutions. There are more direct or indirect ways of giving credit. Maybe as a central bank, you're tying it to certain conditions, or maybe just target certain sectors. But there also interest rates are the central tool of dealing with those monetary flows. So if you have the general interest rate quite high, obviously the lenders are not going to, they have less incentives. It's not that cheap anymore to get money, and therefore it's more restrictive. Whereas when you have low interest rates, obviously the incentive is there to borrow money and use that. Banks obviously lend this money then to companies who want to finance certain projects, mergers and acquisitions, and so on and so forth. But interest rates not only influence banks, but also individuals. On the individual level, if you go to a bank and want to have a loan, the loan is pretty much, or the conditions of the loan are pretty much dependent on what kind of interest rate the bank received from the central bank, under which conditions they received it, because they are using the margin, they're putting a margin on top of it, and then they're lending it to you as a private person. So you are also influenced by the interest rate. And obviously, if you're just considering this process, it obviously seems like, okay, well, if we have low interest rates and everyone is borrowing money from you as a central bank, the supply needs to be there, kind of. And then you obviously offer the supply, you give it to the banks, they give it to investors, businesses, and also private households. And then obviously, the more money is there, the prices go up because there's devaluation. But that is not per se the case. See, if you look at where the money is going and in what way, then you will find out whether this monetary expansion is actually triggering inflation or not. The difference is if the monetary policy is designed that households receive the bulk of the money of the monetary expansion, then you're creating demand incentives. And demand-driven growth in economies is extremely dependent on continuous demand and continuously growing demand. If you are not able to produce continuously growing demand, you are going to enter into a stagnation phase. And it would also mean that production needs to lower its quality, because let's assume you buy a certain good and then your demand is basically satisfied. You don't need it anymore because you have something new. Let's say a lamp, for example. But then obviously you don't need another lamp. But if you then receive more money, and this is the monetary expansion creating demand incentives, you might have the need for another lamp for whatever reason. The lamp is just an example. It can be any other good. But if there is no additional demand incentives in form of more funds to allocate on a monthly basis as an individual household, then the economy creates the demand or recreates the demand by producing low quality goods that break more often and need replacement more often. So if you do not have the continuously expanding demand incentives given by a certain monetary policy, the situation kicks in that the quality of products is going to be reduced, because the assumption is that everything functions in an economy via demand. And this was actually the case over the last 20-25 years. Demand-driven growth was, especially in highly industrialized financial and markets and economies, was the main driver of growth, and the main assumption was as long demand is growing, the economy is growing, which is to a certain degree true, but it's not sustainable over a long time frame. And now, coming back to the argument of monetary expansion and inflation, you can print money at will if you balance out how production and consumption, so supply and demand, interact with each other. We had one-sided growth or one-sided monetary expansion over the last couple of years, meaning that we only served the demand side, always creating demand incentives, especially during the corona crisis, where everyone expected demand to drop, which it didn't actually. It created a situation where we had such an overdemand due to this expansion, or this one-sided expansion, and this is very important. I'm not saying that printing money is not creating inflation. I'm just saying that allocating the printed money to only one side is creating inflation. And this is what happened during the corona crisis. They expected that demand is going to drop. It didn't drop. You have the one-sided push of money towards the demand side for the anticipated drop of demand, which didn't happen. And then the production side was not able to keep up with the highly increased demand. And once that happened, obviously it takes some time to adapt and for the prices and the price increases to kick in. And this is what in the end happened. And then we had inflation. But if during the expansion phase, the money were to be allocated equally to the supply side, so to the production, we wouldn't have the supply chain issues, we wouldn't have the chip shortages, we wouldn't have inflation altogether, because there would be a greater balance between the two sides. So the expansion itself is not the problem, but the one-sided allocation of the newly existent funds is definitely a problem. So the argument is simply not sophisticated enough to say, well, there are people at the printer in nice suits and saying, now we are going to destroy the economy by kind of going against the small man, right? And therefore we have a different kind of situation today, where we have to think about also including the supply side a little bit more. The balance here is very important, and not the actual deed of macroeconomic policy. So I think it will need some adaptation, and it will lead to some sort of a rethinking, because the demand-driven growth has proven quite successful over a certain time frame, and it worked as long as the calculations were accurate and we had a situation that was more sustainable and more predictable. But in within an unpredictable environment such as the pandemic, we had the problem in the end that it was not quite anticipated that demand is not going to drop. It was kind of sticky. But now let's turn to the question of banks and banking crisis. In this case, I have to say that there is a valid point to see banks and banks kind of failing more frequently in the future. And I do think that there is a warranted fear of a banking crisis to a certain degree. Up until now, for example, the Credit Suisse failure was predictable and it was necessary. The bank was so corrupt, ridden by scandals. Management was extremely unsuccessful. Other banks as well, they had management issues in the United States. The Silicon Valley Bank was not very diversified. So there are explanations for all the bank failures that we've seen until now. But I think there's a very big risk of banks, of more banks failing, and also big banks, because we had a certain period of demand-driven growth, right, as I just explained. And during that time, private households, just as it was in the run-up to the 2008 crisis, households borrowed so much money for buying houses, and all those mortgage loans were taken during times of extremely low interest rates. If you now have to renew the mortgage contract, right, you will get the current interest rates. Meaning that, yeah, when you first took out this loan, you had to pay like 0.2 or 0.5% interest on that loan. And now with renegotiating or with the contract extension, you'll probably have to pay 4 or 5 or 6 or sometimes 7, 8%, depending on where you are, or even more interest rate. But the tricky part is, if you are financially stable, that's no problem. If you are like kind of the premium category, but the subprime categories of loans that were given out during that time of low interest rates, they will have struggles repaying their debt, and they will default. And once they do that, banks will get in trouble, because the time where we had such low interest rates was so extensive that at some point you didn't have prime customers anymore. You had to serve subprime customers in order to kind of stay profitable as a bank. They did so, and those clients now are running into new contracts and mortgage contracts where they have to pay interest that they cannot actually pay. And this is a big problem. And now we see that the one-sided allocation of funds and the one-sided direction of monetary policy of central banks in terms of just pushing for more demand is also detrimental in a way that is able to bring down banks in the end. Is it going to happen? I wouldn't say it's likely. There is a likely risk, but I wouldn't say this is something that I see coming, because usually if we are able to talk about these things in such an environment and people anticipate it, usually these things are not setting in. But I do think that we might see a longer and a more flattened out recession in the end, because the risk management systems today are much better than back in the days before 2008. We have the Basel frameworks, we have much more regulation, we have much closer cooperation between financial markets, where banks are much better regulated. We have much more streamlined banking structures. There are many, for example, investment banking. It's not like people calling clients and saying, hey, you have to buy this stock, or you have to buy this or get this mortgage, something like that. All those things were basically scrapped, and we have a much more secure and stable financial system. It's not that predatory anymore. It's still predatory, obviously. I mean, we're in capitalist system, that's fine, but it is much more regulated, and the structures are much more secure. However, the risk is there because there was a grave miscalculation of just serving the demand side. And on the other side, the supply is having a hard time catching up. And the other risk is that once supply has caught up with demand has dropped to such a level because of inflation that we have kind of a deflationary pressure, because we have more supply than we have demand. So it is an imbalanced situation, and I think it will go back and forth over the next couple of years until we reach a mode where we find equilibrium again, and then we can receive kind of restart into a bull market and another run, and economic expansion in the end. As I said, highly complex, but therefore it is also very dangerous to reduce it to the very simple causality of saying, printing money makes the prices go up. There's some truth to that, but only if the expansion of monetary means is one-sidedly done, by central banks, which was the case here. Nobody talks about that. Getting rid of fiat currencies altogether is something that I'm not even going to talk about. It's laughable actually, and this might be interesting in the context of cryptocurrencies, and I really want to talk about this topic too at some point. But getting rid of fiat currencies it's a joke, just because people think that they are just money printers and it has no value. I'm not going to dive into that, but as I said, inflation obviously a big problem. It is something that has brought down some economies, and it is a stressful situation for a lot of economies. But it's definitely not only because money printers are at work. So always think about balance, supply and demand. Both sides need to be served. And banking crisis, yes, there is some considerable potential for a banking crisis, because the demand side was pushed so one-sidedly, and because of that, the subprime clients of banks are more and more likely to default under the current interest rate conditions that we have. So I hope that this helped you to kind of get a clearer picture of what's going on. And I enjoyed it very much. And I think to wrap it up, the other day I wrote an article about this for a German online magazine, and it was not very the feedback was not very friendly, because people so fanatically and radically believed in the simple causality between printing money. So central banks are just there to spit out money all the time, and inflation, and they just wouldn't believe that those people are professionals that also make miscalculations at time, obviously, but that they have other duties too. And obviously, I don't know, people might think that those professionals are not smart enough to think about these things, because inflation serves nobody. And this is also kind of my motivation for this episode, actually, to kind of explain it in a little bit more detail to you. So, as I said, I enjoyed it very much. I hope you did too. Until next time for another podcast episode of Aceto Magazine. My name is Emre Şentürk. I couldn't even pronounce my name. My name is Emre Şentürk, and I hope to have you back for the next episode. So take care. Bye.